105 WPTI, the Piedmont's news, talk, and sports station. And this is the Wealth Guardian Show. My name is Doug Ray. Welcome. Do you have an IRA? Do you know how or where your money is invested in this critical retirement account? When is the last time you updated those investments? And how will you withdraw money from your IRA in order to avoid thousands in taxes, penalties, and fees? You know, if you're like most Americans, your IRA makes up a big chunk of your retirement savings. But here's the problem. Your IRA is virtually ignored. Sure, you sink money into your IRA every year, and that's great. But you haven't given any thought to your investments or how these investments work with your overall retirement plan. Plus, there's no strategy on how you'll actually get your money out of your IRA. That means you could be setting yourself up to make big mistakes. And according to a recent article out of Forbes magazine, paying a stupid penalty here or not taking advantage of a loophole there could cost you thousands over time. An IRA can be a tremendous vehicle to save for your retirement, but it's really easy to make a number of mistakes, and any one of these mistakes could cost you dearly. Are you about to make a big mistake with your IRA that could cost you thousands? On today's show, I'll reveal how to avoid maybe more than seven, common IRA mistakes that I see almost every week people make. And I'll share some specific strategies that will help you make the very most out of the critical retirement account. But before we get into that, I again want to emphasize the changes in the Social Security claiming strategy that went into effect with the recent government budget signing about a month ago. Please listen carefully. If you're going to be 62 or older by the end of this year, 2015, and you have not started a claiming strategy for Social Security, in other words, if you're not on claim, or if you're not taking benefits, then time truly is of the essence for you. You literally have until May of next year, 2016, to determine whether or not one of the strategies that we've talked about so often over the years on this show is right for you and your family. So I would encourage you to call us at 336-391-3409, and let's discuss this before your time runs out. It is a very, very short window. May is going to be here before we know it, unfortunately. I know things are busy right now. It's the Christmas season, but you need to make sure that you're not about to leave tens of thousands of dollars on the table. All right, well, let's go ahead and get into these mistakes that you could be making with your IRA account. One of them is pretty simple. A lot of people assume that just because they have an employer plan, a 401k or a 403b, something like that, that they can't have an IRA. That's just simply not the case. You certainly can have an IRA. One of the techniques that I talk to my clients about is make sure that you fund your 401k at least up to where the company matches, because if you're not doing that, you're leaving money. I mean, that's free money, and you're leaving it on the table. So make that a standard procedure for yourself. Also, another mistake people make is they don't make a contribution to their IRA because it isn't tax deductible. Well, here's what I tell folks. If I had the option, I would rather make a non-deductible Roth contribution anyway, because it is my belief, and everybody I talk to believes, that taxes will be considerably higher in the future than they are now. So a Roth IRA, if you haven't gotten one started, you should think about it, because a Roth IRA, the money in there is going to grow tax-free, and when you get ready to take it out in retirement, it's going to come out tax-free. Lots of reasons to contribute to a Roth IRA, even though you don't get a tax deduction. The next mistake is just simply not maximizing your contributions. I don't know why people don't maximize their contributions. You can certainly do that. You should do that. it's the old adage of pay yourself first. Make sure you're putting money away to the maximum amount possible for your retirement, because nobody else is. Most people don't have the pension plan anymore, so you have to take care of yourself. Here's another mistake: not taking advantage of a Roth IRA. I spoke about Roths a minute ago, but the Roth IRA to me is one of the best kept secrets because of that tax-free deductibility. Now let's talk about a Roth for a minute. You can make contributions into a Roth account if you're over 50 up to $6,500 a year. Now there's some income caps on it. If you're a married couple filing jointly, if you make over $194,000 a year, you cannot make a contribution. But you can do a conversion. You can convert your old IRAs into your Roth IRA. If you just joined us, this is the Wealth Guardian Show on 94.5 WPTI, and today we're discussing common mistakes I see people make every single day with regards to their IRAs. And the IRA has become one of the largest assets a family has. It's right up there with the value of the home. Maybe even some folks' IRAs are more valuable than their home. The other mistake that I see, and this is a costly mistake, is some people fail to take their required minimum distribution. When you turn 70 and a half and you have funds in an IRA, you have to take some money out. The government requires it. And failure to do so is a 50% penalty on the amount you supposedly were supposed to have taken. So, for example, let's say your required minimum distribution is $5,000 and you fail to take that $5,000, then the penalty for not doing that is $2,500. Why give the IRS any more than you have to? That just doesn't make a bit of sense to me. Before I go on with some more mistakes that I have seen people make with their IRAs, I have a question for you. Do you worry if you'll run out of money in retirement? Do you know if you'll be able to maintain your same lifestyle in retirement, or if skyrocketing cost of health care could wipe out your entire life savings? If so, you're not alone. Anyone retiring today worries about the exact same things. I see it over and over again, and that's where we can help. We've helped hundreds of people retire successfully right here in the Triad, and we can help you too. Get the answers with a customized retirement master plan. Your initial analysis won't cost you a dime, and there's no obligation. And what you learn could change everything. If you've recently retired or you're within 5 years of retiring, then give us a call at 336-391-3409 to schedule your customized analysis. The sooner you get started, the better off you'll be. Get started today by calling 336-391-3409. All right, let's carry on with some more mistakes that I've seen people make with their retirement accounts. Paying unnecessary penalties and early distribution fees. This happens quite a bit. One of the culprits, one of the chief causes of this is people having to take monies out of their IRA before they're 59 and a half. Now, some people have to because of, laid off from work, unexpected tragedies, emergencies, things like that. But for goodness sakes, don't take money out of your IRA to buy stuff. Don't buy a car with monies from your IRA. I want you to think of your IRA account as, put it on a pedestal. That is money for your retirement years. That's what you and your family are going to use to get you through the golden years of life. So taking money out to buy a car. I've even seen people take money out to buy a house. Now, you know what that does? If you take money out of an IRA to buy a house, and let's say you're over 59 and a half, so there's no early distribution penalty, you are right then and there causing the cost of your house to be about 30% more than it is. Why? Because taxes are involved. Here's what you got to think about. When you see your IRA account statement, it says your name, IRA, right? But here's what it should say. It should say your name and the United States Treasury IRA, because believe it or not, they own some of that money in there. For most of you, it's going to be about 30% if you count state and federal taxes. So again, I would suggest you think about doing a Roth conversion with some of this money. You know, I love Roth conversions, and a strategy for a Roth conversion we use a lot in our practice is a bracket bump technique, and that's basically taking enough money out of your IRAs every year to bump you up to but not into the next tax bracket. And what this is doing is, yes, you're not going to get all your IRA converted in 1 year, but what it will do for you is over time you will get enough of your IRA converted so that you have done it in the most tax efficient manner possible. All right. If you're interested in that, give us a call, 336-391-3409. One more thing before we have to go to break. I want to talk about beneficiary statements, or making a beneficiary statement. It is so important for you to make a beneficiary statement on your IRA accounts because IRAs pass via the beneficiary statement. You should have a primary beneficiary, and you should also have a secondary beneficiary. And that basically means that somebody, if your primary beneficiary passes away before you do, then the contingent or the secondary beneficiaries will step up as the primary. Typically what I see is the spouse is the primary beneficiary, and then the children are named as the secondary or contingent beneficiaries on the account. And with the stretch IRA rules in place, it makes so much sense to do that because now you're creating a family legacy that can be handed down from generation to generation. Well, we'll be right back in just a short minute or two. You're listening to the Wealth Guardians on 94.5 WPTI, the Piedmont's News Talk and Sports Station. Well, welcome back. I'm Doug Ray. This is the Wealth Guardian radio program. Our motto has always been, we tell you what you need to hear, not necessarily what you want to hear. If you're like most Americans, your IRA makes up a big chunk of your retirement savings, but there's more to your IRA than meets the eye. Are you better off converting your traditional IRA to a Roth IRA? Is there a strategy to avoid what could be thousands in taxes and penalties and fees? Have you given any thought to your investments inside your IRA or how these investments work with your overall game plan? One simple mistake here could cost you thousands, if not tens of thousands of dollars over your lifetime. Coming up in this segment, we're going to reveal some more mistakes that I've seen people make in my 29 years now of practice in the investment services business. And I'll reveal some specific strategies that could help you make the very most of this critical retirement account. All right, let's get back into this. One thing that I've seen before is people not taking advantage of something called net unrealized appreciation. Now, that's a big fancy term, and what it really has an impact on is for those of you who have company stock inside an IRA, and I know a lot of you out here do. What is this going to do for you? What does it mean for you? Well, it's a way to hopefully minimize taxation of these funds, because you know when you take monies out of your 401k or your IRA, it's going to come out taxable. So here's a mistake. Let's say you had highly appreciated company stock in your 401k, and you roll all of that over to an IRA. Any IRA custodian will do that for you. They'll take that company stock and roll it right in there. But once you do that, you've given up a valuable tax strategy. Now, here's what I mean. The IRS does something really cool here, and believe it or not, it's going to benefit you. They'll let you do this. they'll let you take that highly appreciated stock and pull it out of your 401k. It's just a withdrawal. Now, here's what they'll do. You'll have to pay tax on the basis, not the full amount. So let me give you an example. Let's say your company stock is worth, let's say, $100, but your basis is, say, $20. So you could pull every share of your company's stock out at $100 a share and only pay tax on $20. Now, that's pretty cool, right? Now, what if later on you go to sell that stock? Well, then when you sell it, the gain, the difference between the 20 and the 100 or whatever you sell it at, is going to be long-term taxable gain. So literally you could shave several percentages of tax liability with that one simple trick. And the other thing that it does for you is it gives you the opportunity to get monies out of your 401k and get diversity going on. So don't forget about net unrealized appreciation. One other thing I'd like to say, there's a great website out there. One of them is my website, thewealthguardians.com, but another one that I want to bring your attention to is www.irahelp.com. Now, this website is run by Ed Slott and his associates. Ed is a CPA, and he is just renowned as one of the leading experts on anything to do with IRA, 401k, and Roth IRAs. There is a wealth of knowledge on his website. You can even email his staff if you have a question. And I am one of Ed's elite IRA advisors, one of a very few here in the Triad area that I work with Ed in helping him and his folks and you folks with some of your complex IRA questions and problems. Let me give you an example of one that surfaced just recently. A gentleman called me up out of the blue because he was on Ed's website, IRAhelp.com. And they have a unique situation, which it will segue into another mistake that people make with their IRAs. His wife had just inherited from her father a $300,000 IRA. Well, you say, wonderful, right? Well, here's the problem. She has a brother and a sister, but she was the only named beneficiary on this account. Now, I don't know why the father disinherited the other two children. That's beyond the scope of this story, but he did. Maybe it was a mistake. Maybe it was intentional. I don't know. But it left the daughter that inherited the IRA with a problem because she wants to do the right thing. She wants to have her brother and sister get a third of it. Well, what is she going to do? How can she do it? She can't just take that IRA account now and transfer it to brother and sister, a third and a third and a third. She can do this. She can literally take a distribution of 2/3 of the IRA, but then she has to pay the tax and give what's left over to the brother and the sister. She could do that. But that's really not going to help her either. There's something else that she could do. She could disclaim it. She could say, hey, I don't want this. And then it goes back to the estate, but then taxes will be due on the whole amount and the whole IRA gets wiped away. She was left with a really, really big problem. And hopefully we're working on ways to help her resolve that problem. But that is a huge mistake in not naming the beneficiaries the way that you want them named. Because the beneficiary statement trumps everything. There is case law that literally went to the Supreme Court in an example. If you have a situation where either you've had a divorce or you've had a death in the family, you need to make sure you check all of your beneficiary statements and make sure that they're updated. I encourage my clients to do this on a regular basis. Now, you don't have to do it every year, but every 5 years, or if a triggering event happens, such as a death or a divorce or something. I have a question for you. If you were forced to retire today, are you prepared? According to USA Today, 60% of Americans retire unexpectedly. You lose your job, you get laid off, downsizing. You, your spouse, or a parent's health take a turn for the worse. Something like that could happen. It happens, believe it or not, to 6 out of 10 people. Life can change in a heartbeat, and you need to be prepared. But being prepared isn't about achieving some random number from a calculator or simply picking a handful of stocks and bonds and mutual funds. It's having a complete plan that covers everything, and that's where we can help. We've helped hundreds of people retire successfully right here in the Triad, and we can help you too. Prepare yourself now with our complimentary Retirement Master Plan. Appointments are filling up quickly for the balance of this year. So if you've recently retired or you're within 5 years of retiring, then call us at 336-391-3409 to schedule your customized Retirement Master Plan. It's free and there's no obligation. That's 336-391-3409. The initial analysis will not cost you a penny, and what you could learn could change everything. 336-391-3409. All right, if you just joined us today, we are talking about mistakes that people have made over the years with their IRAs and their 401ks. I've certainly seen a lot of them. But before we get back to that, I do want to remind you, if you just tuned in, about the change in Social Security claiming strategies the government enacted with the recent budget plan. And this is important, very important. I keep saying this because if you're 62 and older, or will be 62 and older by the end of the year, so if you got a birthday coming up like me, I won't be 62 yet, but if you're 62 and older by the end of the year, then you have a very, very narrow window to determine if you want to go down the path of a delayed claiming strategy. That window closes completely for you come May of next year. So I want you to call us, 336-391-3409, if you will be 62 or older by the end of the year and you have not started taking your Social Security benefit and you want to find out if a delayed claiming strategy makes sense. Remember, delayed claiming strategies can get you up to $50,000 or more dollars over your lifetime than if you just started taking your benefits as soon as you're eligible to. So call us at 336-391-3409. All right, back to mistakes with IRAs. Here's another one. I see this cropping up more and more in the last year or so. People are wanting to make the beneficiary of their IRA the trust, a trust that they've created. Now, generally, that is not something that you should do because it could trigger immediate taxation of those IRA dollars. Remember, an IRA is going to go directly to the beneficiary or beneficiaries. It avoids probate anyway. So unless you have a very, very complex situation in your family, I generally discourage making a trust the beneficiary of the IRA dollars. Maybe you're going down the path of a charitable donation. Well, you could do that without using a trust. I mean, you can just name the charity the beneficiary right on the beneficiary form, and that might be a very good strategy for those of you who need some tax deductions or you have income from other sources and you don't need the IRA dollars. But there's other strategies as well that you could put into play to avoid taxation on those IRA dollars. Well, we've enjoyed this little show today, and if you're interested in talking with us about your IRA, 401ks, things like that, the number to call us here in the Triad is 336-391-3409. I look forward to speaking with you about your situation. And as always, we'll see you next week. This is the Wealth Guardians on 94.5 WPTI, the Piedmont's news, talk, and sports station.